Imagine watching an entire year's worth of hard work disappear in 10 minutes. The market turns, prices plummet, and your screen is painted in red. Meet Trader A. He's sweating, his heart is racing, and he's frantically hitting the refresh button as his account balance drains. He's operating purely on panic. Now look at Trader B. She's watching the exact same collapse on the exact same screen, but she is completely calm. She taps a few keys, exits her position, and preserves her core capital. Why do two people looking at the same price chart walk away with such different financial results? It is tempting to think Trader B has a hidden algorithm or a secret indicator that predicts the future. But the reality is much simpler. No one knows what the market will do next. Professionals survive for decades, while beginners burn out in months because they operate on an entirely different psychological framework. To see how Trader B maintains that control, we have to look past the charts and into the specific mechanics of her decision-making process. The split between these two mindsets happens before a trade even begins. When Trader A spots a fast-moving stock, he asks one question: how much money can I make? When Trader B looks at that same opportunity, she asks, if this goes wrong, how much will I lose? She starts with the assumption that the setup could easily fail. There is no perfect pattern, and absolute uncertainty exists in every single trade. Because of that risk, her highest priority is building a fortress around her current money. Any potential profit is a secondary concern. If you drain your account to zero, your trading career is over. You cannot play tomorrow if you lose all your chips today. Survival has to precede profit. This focus on survival changes how losses feel. Trader A treats a losing trade like a personal failure. Trader B treats it like a standard business expense, no different than a restaurant owner buying ingredients. This chart breaks down 10 trades. A professional might only win half. 5 illuminate green for a win, and 5 turn red for a loss. But when wins are scaled twice as large, they absorb the small losses, leaving a profitable return. The goal isn't to be right every time. It's to ensure that when a trade does fail, the loss is pre-calculated to stay small enough to keep the business running. Suddenly, a ticker symbol flashes across the screen. A tech stock just jumped 10% out of nowhere. Trader A feels that immediate sting of missing out. He convinces himself it's going to the moon, bypasses his rules, and hits the buy button purely out of fear. Trader B sees the same jump. Instead of reacting, she consults her trading plan. She checks her required entry price, her exact risk limits, and her exit strategy. The setup doesn't match her criteria. So she lets the stock run without her. She knows the market is an engine producing an infinite number of opportunities every single week. By refusing to break her rules, she removes emotion from the equation. A predefined plan acts as a circuit breaker, preventing an emotional impulse from turning into a physical trade. That strict adherence to a plan points to a deeper shift in thinking. Trader A desperately needs this specific trade to work out. Trader B doesn't care if she wins or loses this individual hand. This chart illustrates a statistical edge. Up close, a casino cannot predict the next blackjack hand. Data points scatter randomly. But zoomed out over thousands of hands, a clear, upwardly profitable trend emerges for the house. Professionals operate exactly like the casino does. When you apply a proven mathematical edge across hundreds of iterations, you stop trying to predict individual outcomes and simply let the math do the heavy lifting. Fast forward a few months, and the daily routines of these two traders look entirely different. Trader A sits exhausted at his desk, forcing trades just to feel the thrill of the action. Trader B spends most of her time observing, resting, and meticulously logging the details of her past trades in a journal. Over a multi-year period, their account balances reflect those habits. Trader A suffers through a wild cycle of massive gains followed by devastating account blowups. Trader B produces a boring, steady, upward climb of compounding growth. That commitment to tracking metrics and auditing mistakes is the dividing line. It elevates trading from a trip to the casino into the daily operation of a structured business. Raw excitement burns out quickly. It's the quiet discipline of keeping records and following rules that actually compounds into lasting wealth. Building that wealth is a lot like planting an orchard. An amateur plants a seed, digs up the dirt the very next morning to see if anything sprouted, and quits out of frustration. The professional puts the seed in the ground and silently waters the soil every day for years without demanding an immediate harvest. To cross the bridge from amateur to professional, you have to change what you value. You have to stop grading yourself on the outcome of a trade and start grading yourself on how well you executed your actions. Amateurs obsess over the profits they cannot control, but when you master your risk, manage your mind, and execute the process flawlessly, the profits arrive on their own.